Welcome to the market recap of the week. The Federal Reserve has increased its benchmark interest rate by 0.25% to a new range of 4.75% to 5%. This is the highest rate since October 2007, and the reason for this move is that the central bank is trying to combat stubborn inflation and a banking crisis caused by the pandemic. It's a significant emergency action taken by the Fed. They've also made it clear that they plan to end their cycle of rate increases and have removed the language suggesting ongoing rate increases in interest rates. The officials have stated that they intend to continue their current balance sheet runoff as planned. All the members of the FOMC, Federal Open Market Committee, voted in favor of this decision on Wednesday. When the Federal Reserve increases interest rates, it can have a significant impact on the stock market. This is because when interest rates rise, it becomes more costly for both businesses and consumers to borrow money, which in turn can slow down economic growth and lead to a decrease in corporate profits. All of these factors can ultimately lead to a decline in the value of stocks. However, it's important to note that there's no guarantee as to how the stock market will react to any particular change in interest rates. The market can be influenced by a variety of factors, including global events, company news, and investor sentiment, and it's impossible to predict with complete accuracy how it will respond to a specific change in interest rates. The U.S. stock market ended the week on a positive note, with major indexes rebounding from early losses and closing moderately higher on Friday. The rise was led by bank stocks that gained momentum after Treasury Secretary Yellen called an unscheduled meeting of the Financial Stability Oversight Council, FSOC, to address concerns about the stability of the banking sector during global turmoil. The FSOC released a statement saying that despite some stress, the U.S. banking system remains sound and resilient. However, the banking turbulence also had an impact on global bond markets, with investors seeking safety in government debt. On Friday, the 10-year T-note yield dropped to a 6.25-month low of 3.280%, while the 10-year German Bund yield and the 10-year UK gilt yield also fell to multi-week lows. Additionally, there was a record inflow of nearly $143 billion into global cash funds during the week through Wednesday, as investors fled from the volatility in financial markets. One of the top performers in the S&P 500 and Nasdaq 100 on Friday was Activision Blizzard, which saw a surge of over 5%. The video game maker got a boost from a positive update from the UK's Competition and Markets Authority on Microsoft's acquisition of Activision. The regulator stated that new evidence suggests that the acquisition would not significantly reduce competition in console gaming in the UK. Netflix also saw a rise of over 2% on Friday, following a bullish note from Bank of America. The bank highlighted positive trends for subscriber numbers for Netflix, citing the company's efforts to crack down on password sharing among accounts. Additionally, Bank of America noted that Netflix has a strong content slate for 2023 and beyond, which could drive further growth. That is the end of the episode. Have a nice day and thank you for listening.